Why credit income summary? Actually, as you will realize later on in the topic of closing entries, the income summary account is representative of a business entity's net income or net loss. It has a credit balance when there is net income because the total revenues are greater than the total expenses. Recall that the normal balance of revenues is credit. That's why when there is net income, that means total revenues exceed total expenses, the income summary account has a balance of credit. In case of net loss, the income summary account has a debit balance because in net loss, the total expenses, the normal balance of which is debit, exceed the total revenues. Now, going back here and to the question of why the income summary account is credited, it is because recognizing merchandise inventory end has the effect of decreasing the cost of goods sold or cost of sales and consequently increasing the net income. Remember, I just discussed that in case of net income, the income summary account has a normal balance of credit. Now, let me illustrate how recognizing merchandise inventory end has the effect of decreasing the cost of goods sold and consequently increasing net income. By now, you should be familiar with the computation of the cost of sales or cost of goods sold already. That is, merchandise inventory at the beginning of the period, then add net purchases to get the cost of goods available for sale. Then deduct the merchandise inventory at the end to arrive at the cost of goods sold, which when deducted from the net sales will give us the gross profit or gross income. When we deduct the operating expenses, assuming no income tax, then we get the net income or net loss. Assuming that it's the first accounting period of the business, then there is no merchandise inventory beginning. Let's say the net purchases for the period totaled 545,000. In that case, the cost of goods available for sale must be 545,000 also. Let's say the company did not recognize any merchandise inventory at the end of the period. The cost of goods sold then would be 545,000 also. With net sales of 750,000, gross profit would then be how much? 205,000. Assuming operating expenses of 120,000, net income would be 85,000. But what if the company recognized merchandise inventory at the end, amounting to 95,000 pesos? What then would happen to the net income? Let's try it. So, merchandise inventory at the end, 95,000. Then the cost of sales will become 450,000. 450,000 cost of sales subtracted from the net sales of 750,000 equals gross profit of 300,000. 300,000 minus the operating expenses of 120,000 would give the net income of 180,000. Notice that this 180,000 pesos net income now is greater than the 85,000 pesos previously computed when no merchandise inventory at the end was recognized. That is why, as I mentioned earlier, the net income increases when merchandise inventory at the end is recognized. Therefore, here, in recording the merchandise inventory at the end, the income summary account representative of the net income must be increased by crediting it for the amount of the merchandise inventory at the end of the period per physical count.